Take the discussion forward on fundamentals with Ashwini Agarwal joining us, founder of Demeter Advisors. Ashwini, good morning. Good to see you. Ashwini,
Good morning.
I'd like to start our chat with the commentary of RBI governor this time around. One section of the market found it slightly, extra hawkish than usual. Usually, our RBI governor has been very watchful, ever careful about any, very, very calculated about what messaging is being done. But yesterday, it was very clear that the priority is to contain inflation in our limit and in the markers, prescribed markers, so that the durability of growth can be ensured, even if it to the extent of not pleasing the markets. And initially in the first half, markets cracked sharply before that. And of course, going after, areas of the credit which is becoming slightly amber now, like top-up loans, etc. What did you make of it? And in this light, how do the lenders pack look? Because they've been underperforming for a long time.
Yeah, no, I think it's a great question. But, personally, I think the Reserve Bank of India has done a stellar job in communicating its policy stance and its objectives. If you think about, what the street was expecting ahead of the policy announcement and what was finally delivered, there is absolutely zero difference. Nobody expected any rate cuts. Nobody expected any signaling of any sorts. The RBI governor has been very clear that it is inflation that he wishes to target. And till the inflation is firmly out of the way, there is no question of interest rates being rolled back or liquidity becoming a little more accommodative. In his previous policy, he spoke about the elephant heading to the jungle. The data points since then haven't shown much progress on that journey. So, I wasn't very surprised as to what the RBI policy said or how it was framed. I think it was very consistent, and that it's all credit to the RBI on that front. On the credit quality issues and the RBI's concern on unsecured loans and top-up loans, again, this is an area that the RBI has been highlighting, that unsecured loans is something that the lenders need to be careful about. They've said as much in several communiques and in policy guidelines, asking for extra capital on certain types of loans and asking the microfinance institutions to be more watchful of people who are overdrawing, etc. So again, I don't think it is out of line with what they've done. And clearly, if you see the numbers from several of the MFIs as well as some of the banks, there is marginal incremental stress that's starting to show up in the unsecured loans area. So I don't think RBI was without reason when it highlighted or red flagged these issues a few quarters ago. So what does this mean for the lenders? So, markets are about incremental change. So if you think about the operating environment for lenders over the last 8 quarters, it was a very benign environment. Liquidity was adequate, in sometimes surplus. You had significant credit cost declines way below long-term sustainable credit cost numbers because of write-backs and because of recoveries. And now you are going back to an environment which is a little bit more normal in the sense that there is credit cost in the system. I mean, there is a sustainable cost in terms of loan losses that any lender will have to bear over a long period of time. But I think the problem that the banks are facing is tight liquidity. So there is a compression in NIMs. There continues to be pressure on operating expense because you need to keep pace with technology. And then the credit cost, which was providing a tailwind in the last 2 years, is no longer a tailwind. It's not a headwind, I would say, but it's no longer a tailwind. So, the incremental change for lenders is not that great.
Fair point. Let's also move on and talk about another area of the market which is showing a stealth, kind of a bull run, which is the pharma space. It is third quarter in a row that we are listening to very strong commentary coming in from the likes of, Lupin, and of course, coupled by big upgrades. Others also not bad in the mid-tier or even small cap. This is one area which is, how have you positioned in the pharma space across market cap, or you're sticking to the big ones?
No, we've been very bullish on the upstream chemicals and pharmaceutical space for a couple of years now. And as a family office, I have made investments across the market cap curve. Obviously, no recommendations being made, no names being shared. But I think the way I've thought about this is that the sector went through a significant margin compression because of the volatility of raw material pricing in the post-COVID environment, and that has normalized, which has allowed the margins to normalize. Also, the pricing for generic drugs is a little less onerous in the United States, which is the principal market for a lot of the Indian exporters, than it has been in recent years. And last but not the least, the domestic market continues to do well. So I think, it's all good. And then, of course, there are a couple of these very large one-off opportunities which are holding up earnings for some of the large players.
Fair enough. What's the outlook then when it comes to the overall earnings season? Can you just walk us through in particular what you've made, for example, of the IT numbers? Because FPIs have been aggressively buying into this space with optimism that earnings could potentially improve, etc. What's your view on the earnings?
So earnings were a little better than I expected for the IT space. As we are all aware that the IT space has been really struggling to please investors for the last 8 quarters or so, and this quarter was a little bit of a mixed bag. Couple of disappointments, but couple of fairly optimistic numbers and optimistic commentary. And I think that's what's leading investors to pile into the IT names, in addition to the fact that, relative to the rest of the market, this looks a safer space, from a valuations perspective, from a cash flow, a price to cash flow perspective. So I think that's what's driving the investor interest in it. My personal view is that I still find IT to be a little expensive relative to the past, and sustainable growth rates, don't look that exciting to me for at least the large cap cohort. There might be a few bottom up opportunities in the small and mid cap space where there are companies catering to AI rollouts in particular, or there are companies that are growing off a very small base, or there are some product type plays. But that's a more bottom up investing in IT for me.
So, Ashwini, what percentage of your portfolio is cash right now, or are you advising investors to go all in and be fully invested?
So no advice again from my end, but I can share where I am at. I've been in a lot of cash relative to where I would like to be for 3 or 4 months. So it's been painful. The only consolation is that the equity exposure has done reasonably well. So I think it's a glass half full, half empty, the way to look at it. I find markets to be expensive. I think the earnings momentum outside pharma, outside IT, and a couple of other pockets is starting to wane. The global outlook is very hazy and complicated, and Indian markets are very stretched, and supply of paper is catching up. So in that context, I've always said that one way to manage risk for any investor is to run equity exposure in a band. So if you're feeling very bullish, you should be at the upper end of your equity exposure band. And if you're very bearish, you should be at the lower end of the equity exposure band. I mean, you shouldn't be zero equities, even if you're very bearish, because who knows, you could be wrong, right? I operate in a band, and I'm closer to the lower end of my equity exposure, and I'm on the upper end of my cash exposure at this point in time. That's something that I can share.
Right. So, Ashwini, I'm curious to know what's going to propel you to buy, how much of a fall, or any other trigger, and what's the shopping list looking like? I'm sure you've got one ready already.
Yes, of course. So it's very contextual. So, one will have to see. It might be a few bottom-up ideas that interest me because, if you look through the market, there are a whole bunch of stocks that are actually down 50% from recent highs. I mean, the market obviously is holding up, but the correction in individual stocks has been quite decent, and some of the places are quite interesting. We spoke about financials. At some point in time, one will have to look at financials as well and say that is the incremental bad news less than the incremental decline in the share price. So, that's what creates opportunity. So for me, it's always bottom up. If I find bottom up ideas that make sense to me from a risk reward perspective, I'm willing to invest. It's not really that much about top down of the market. It's more about bottom up. There are names that I'm interested in, and there are prices at which I'm interested in those names. And if those prices come, hopefully I'll buy.
What are your thoughts on the consumer end of the market? I mean, you're positive on it. It's not done well for a very long period of time. Are things really turning on ground? And which section of the consumption basket would you start nibbling in?
So, a great question. I think, the consumer sector has also struggled with fairly weak demand in rural India. And now it appears that even in urban India, demand appears to be slowing. I mean, barring, things like air conditioners, which have done phenomenally well, thanks to the very excessive heat that we faced this summer. But outside of that, I think things are on a slow grind. I've been hoping to see an improvement in the rural demand, propelled by the expenditure that took place during the elections and hopefully good monsoons and higher crop prices this year. Also, I think the job market has normalized more or less. So the transfers from urban India to rural India should pick up again. That's again a hope that I have. I don't have a lot of data points to pin this thesis on, but keep looking. And I think if you look at the results of some of the companies that cater to rural markets, we've seen pockets of improvement in demand, not across the board, but pockets. So we'll have to see how this evolves. I'm optimistic, but I can tell you that it's not a view without a risk.
Right. All right, Ashwini, thanks very much for joining us. We'll let you go on that one.
If you like this video, then like, share and subscribe to ET Now.